Any one of you, can you tell me where we stopped in the last class?
Sir, specific documentation for auditing, sir.
Specific documentation for auditing SA 230. Okay. I think I must have started with SA 320 materiality. Let me see. Where is my PDF? Okay. So we'll start with. Okay. We can start with SA 320 or let's start with 315. Okay, so I'll start with SA 315. We were done with SA 320 in the previous class. Now, this SA 315 is something very important. The standard looks small, but from a technical perspective, this standard is quite important. This is what lays the foundation for everything else that is coming after this. All the standards that come after this is the standard that basically. This is the standard that basically lays the foundation for all the other standards. Okay, so let me share my screen. So you guys can see what is being shared.
Yes, sir.
Okay, so this standard is critical, so please concentrate. SA 315, the heading says identifying and assessing the risk of material misstatement through understanding the entity and its environment. First, let us try to understand the heading of this standard. When we are given any work to do, it is important that we understand what is required of us, what is the work that we have to do, isn't it? Otherwise, what happens is there will be delays, there will be confusions, there will be a wrong outcome, or it could be that we always need to do is understand what we are going to do. So that is what this standard says. This standard says first identify and assess the risk of material misstatement. Identify and assess the risk of material misstatement through understanding the entity and its environment. Understand the entity and its environment. Entity and its environment, Abhina. What is the entity, the organization that we are going to audit? That is clear. But what is environment? Environment, Abhina, here you can see this particular column, entity and its environment, Abhina. It could be the industry or regulatory and other external factors. That means it could be the laws and regulations that are forming part of that industry. It could either be the laws and regulations forming part of the industry, or it could be the operating environment, how they operate, what they operate, what exactly do they do, what exactly do they produce, what exactly do they sell, what are the legal aspects that affect them, how many people are there in the organization, what are the accounting policies that are applicable for them, what kind of expertise is sitting there, like are the accountants chartered accountants or simple normal bcom accountants. All of this has an impact because you need to understand what you are getting into. So when there is a chartered accountant sitting there, naturally the quality of accounting will be definitely different from that of a bcom accountant, isn't it? And that is the general thing wherever you go. Whenever you have a qualified professional, you generally have the quality higher. And why would a chartered accountant sit in an accounting role? If it is a big company like Tata's, ITC's, Birla's, Reliance, big companies, they definitely hire chartered accountants even for a small scale roles also. So understanding the entity and its environment includes understanding the operation, the legal side to it, the rules and regulations applicable, the company law that is applicable, the accounting policies that are there, what are the operations, how much are they earning, what is the business risk. Business risk basically is an effect on the EBIT, EBIT. Are they able to achieve the EBIT or not? If they are not able to achieve, is there a going concern or not? All of this you need to analyze even before you enter the organization. That is important. You need to understand the entity and its environment, everything surrounding it. You need to have a grip on it before you enter the organization, so that when after you enter, if someone asks you some question or says something, you shouldn't be suddenly rattled. It's so many times it happens to all of us that we go there without having a dime knowledge of what we are going to do there. And this is not the fault of a senior, because even the senior faced the same thing, because even the senior doesn't know what to do once we go there, isn't it? This is something that the chartered accountant needs to sit and explain. If you remember in the previous standard, it was direct, supervise, and review. It is something that is responsibility of the chartered accountant to explain to his team. Now, this explanation should include what the entity is, what its environment is, how this entity is placed in the overall the industry. How does this entity earn? What are its challenges? What are the major areas that could have a risk? All of it should be understood by the chartered accountant and explained to his team before the audit is taken up. And this is one of the standards that is mostly ignored, and that is where the problems arise, because without understanding the entity, they enter into the organization thinking that we will learn there, but later on you spend a lot of time learning and not doing the actual audit. So if it is possible for you, try to understand the entity before you step in. Now, Understand the entity and its environment part we understood. This is what we need to do. Industry, regulatory and other external factors, nature of the entity, accounting policy, business risk. Business risk, like I said, whether the company is able to achieve the EBIT or not, EBIT, earnings before interest and tax. Now this is what you need to understand before stepping in. Now, what are you trying to do? By understanding this, what are you trying to do? You're trying to assess and identify and assess the risk of material misstatement. What is misstatement? Misstatement is something going wrong in the financial statements, either knowingly or unknowingly. Something might go in the wrong in the financial statements, books of accounts. Why do they add the word material to it? If you take a 100 rupee query to the board of directors of a company that is earning 10,000 crores, they will change the auditors the very next moment. Because for a 10,000 crore company, 100 rupees is literally nothing for them. So you need to have a materiality level established to that particular organization. What is the right materiality level? Like we studied in the previous class, there is no exact number that will say that this is the exact materiality level. We just need to follow the industry standards, 10,000 rupees or 5% of sales, 10% of fixed assets, like this. There is industry standards which you need to consider and apply to that. Or otherwise, if you want to apply a different number, that is well and good. You are the chartered accountant while auditing. It is your decision to decide what is the materiality level. So, risk of material misstatement. We are not talking about silly misstatements. We are talking about a risk of a material misstatement, which can have a significant impact on the financials of the organization. What is that? Identifying and assessing the risk of material misstatement. Not just identifying, we need to also assess what are the things, what are the areas that can have this issue. Let's say some industries operate a lot in a lot of compliance related areas. Like let's take the example of factories. Factories generally operate in a lot of legal requirement areas. So there is naturally a possibility that they might not comply with one or the other law. It is by default, because when you have 40, 50 laws and you have a 500 or 1,000 workforce and you have a very small team at the office, because office doesn't require a large team for a factory. It is all labor on the ground which actually do the operations. So when you have such a large scale people working and the factory people are very minimal, then it is quite obvious that they might be missing complaints with one or two laws. That happens every time, almost every time in all of the factories. So this is one area when you know that it is a factory, when you know that there will be so many laws, when you know that the team size is low, there is a natural conclusion that these areas might not have been complied with. These areas might not have, there might be some misstatement to that. So similarly, depending upon the organization, you need to look into those compliance requirements or accounting requirements, everything. So identifying and assessing the risk of material misstatement through understanding the entity and its environment. That is what they're telling you. The daddy is telling you, I see. First, understand before you step in. Now, let us try to look at what is the identification procedure. Identification and assessment. How do we do that? First one, risk assessment procedures. These are the things you need to carry out to understand or identify whether there is a risk of material misstatement. First one, identify financial reporting framework. This is a keyword risk assessment procedures, entity and its environment, components of internal control, risks of material misstatement, all these are keywords only. Even the word financial reporting framework, reporting framework அப்படின்னா whatever standards you are using to generate a report basically are called as the reporting framework. When you're preparing and publishing the financial statements, it is called the financial reporting framework. What is the basis for the financial reports? It is the accounting standards. Accounting standards are the one which are telling you how to account, what are the entries to be posted, how to post the entry, how to present those financials, what is the headings that needs to be there, what is the manner of presentation, where should the notes be. Everything is coming from the accounting standards, isn't it? So the reporting framework basically means, or basically the framework basically means the base document based on which something has been prepared. Now the reporting framework means this report has been prepared based on some particular document. They are giving you clearly financial reporting framework. When they say financial reporting framework, they are talking about the financial statements, which are the audit, which are the final report, and the financial statements are prepared on based on which framework? It is the accounting standards. So in India, it is either Indian accounting standards or accounting standards. So that become the financial reporting framework. First, need to understand what accounting standards are applicable to them, because accounting is the very basis behind all the financial statements. So if they have complex accounting like hedge accounting or hedge this thing derivative accounting, it naturally is an area that cannot be skipped. That is one of the high risk areas, and you cannot think of skipping it at all. Leasing under the last 2 3 years there were a lot of significant changes. So leases is one area which is constantly being monitored currently. And naturally, there were a lot of organizations where they applied rules which were different from the India's requirements. So this is one of the common areas where you know that there could be challenges or risks that you are facing. Maybe either because there is a change in the standard, or because the area is critical, that you may generally see that there is some difference or some difference of opinion or some different method of application. So first you need to look at the accounting standards that are applicable for that particular organization. Then identify the key risky standards, and naturally those key risky standards will definitely be one of the areas that you need to look into. Second, inquiry, analysis, and inspection. Inquiry, what is that? First, sit and talk with them. What exactly are the policies and procedure? How does the accounting function work? If you are going for a statutory audit, you need to understand how exactly the accounting function works. You need to understand what exactly are the controls they have in place. Controls அப்படின்னா what are the policies and procedure, what are the verification measures, what are the reconciliation measures, what are the signature measures they have. All of this you need to do the analysis, and then finally the inspection. That is where the actual audit comes. The inquiry is sitting and talking with them, analysis is looking at the documents and trying to understand things, and inspection is where you get to do the actual audit. Now, changes from previous audit அப்படின்னா, are there any legal changes from the last time you have audited that organization, or from the last time someone has audited that organization? Any change in law, any change in accounting standards, any change in the operating procedures of the entity? anything, any significant change that can have a major impact on the audit or the financial statements, any legal ruling, any big provision that has been written off or created, any issues with the banking system, a lot of things can change from the previous audit. They bought a new company, they sold a they sold one of the subsidiaries, they bought a new subsidiary, all of it. Whatever changes are there from the previous audit, if there is going to be a significant impact of that change in the current audit, you need to definitely take that into consideration. And changes from the previous audit will always be less than 1 year, because last year financial statements and this year financial statements generally will be with 1 year gap. So you need to understand the environment and the entity and its environment through identifying and assessing the risk of material misstatement. What are the identification procedures? One is the identify the financial reporting framework, then do basic inquiry analysis and inspection, then try to figure out what are the changes from the previous audit, what are the major challenges that the organization is facing, or the major changes that the organization has gone through. Now, next one they are trying to explain is the risks of material misstatement. Where can these risks be? First, they can be at the assertion level or they can be at the financial statement level. Now, what is assertion level and what is financial statement level? Assertion level means accounting entry level. If you remember in the previous class, I was talking about the management assertions. Each and every single entry has some parameters against which you can audit. If there is an asset, you can verify its existence. Existence helps you have a clarity that yes, this is not just an accounting entry, there is an actual physical asset that is lying in the premises of the company. So when you have a physical verification in place, then you will get to know that yes, this is an actual asset. Second, you have completeness, whether all the amounts that are required to be recorded against that asset have been recorded or not. Installation charges, any warranty charges, any taxes that are applicable. Ellame சேர்ந்து you need to create one capital value. Any borrowing cost that can be capitalized, all of this you need to add it to the asset value. That is what is completeness. You need to ensure there is a proper amount that is being recorded in the books. Similarly, there are 3-4 assertions for the balance sheet items, and then you have 4 or 5 assertions for the profit and loss items. So these basically are the entry level. Each and every single entry you can do these assertions verification. So that is the risk of material misstatement at the assertion level. Because of an entry, because of a single entry, or because of some cumulative entries, something has gone wrong somewhere at the financial statements. You are making a small mistake, minor mistake, which is accumulating up to a material misstatement, or individual entries are a material misstatement. So the risk can be either in a single entry or a cumulative part of entries, or they could also be at the financial statement level. What is at the financial statement level? I understand you may do some mistakes at the entry level. After the entry, the only thing that you do is the reports, the financial statements. How can you go wrong at the financial statement level, Abhina? One is definitely the notes to accounts. Notes to accounts, either you are not reporting something, that is also material misstatement, because if you don't explain properly as to why there is a particular number or why there is a significant change from the previous year, then the end users may not be in a position to properly understand the financial statements. or there may be a confusion in the market as to why this number is suddenly coming up in these books. So there are a lot of analysts sitting out there in the market currently, which do a very detailed, comprehensive analysis of the financial statements that are being published, because every single financial statements that gets audited and published, there are data analytics people who sit behind it and audit it completely. So they know if the auditor makes any mistake anywhere, they can catch it much faster. And that too, this happens within seconds. Once the financial statements are uploaded, the statements are uploaded into some artificial intelligence computers, and within immediately the system will come out with errors, or system will come out with areas of concern, and it will say these are the major areas of concern. So then those people will try to look, these analysts, stock market analysts, these brokers, all of these people will try to look for those particular items in the notes to accounts. And then they will try to assess whether it is a significant issue for the organization or not. So most of the ratings generally vary because of this analysis itself. So it's not just at the accounting entry level, it is also at the financial statement level. One of the basic things at the financial statement level is, one is that you have not given a proper disclosure, or the required disclosure is not there. All of that with respect to the notes to accounts. You are not helping the end user understand what the financial statement number is all about. That is one. Second thing, very commonly it so happens, even recently I was working with what recently, just 2 days ago, I was working with one trial balance. I had seen one particular account, and I personally know that the liability of that account is gone, but still there was a credit balance for that account in the trial balance. So I called up the accountant and said, this liability is already paid off. Why are we still showing in the books of accounts? So then he made some superficial change and then immediately sent it to me. He just nullified that account and added it somewhere and sent it to me. I said, if you are nullifying it here, there should be because of the nature of the transaction, there should either be a bank entry or there should be an intercompany entry. So there was neither a change in the bank value, or there was not a change in the intercompany value. So I said, if you have paid this and you have actually made an accounting entry, then obviously it should either reflect in the accounting, the bank ledger, or in the intercompany ledger. So then he was like, yes, sir, I just made only the TB level adjustments. So this can happen to many good organizations in the world. Unfortunately, what happens is people try to do adjustments at the trial balance level. This is where most of the people do these superficial changes. One company that I've seen, they were doing almost $700,000, 7 lakh dollars worth of adjustment in the bank balance. So in the books, if you see that 700,000 will not be there, but in the BRS statement, it will sit as an unreconciled items. It was sitting as an unreconciled item since the last 5 6 years. So when you look at the bank balance in the financial statements, it will look the complete value. But when you go into the accounts and look at the bank balance as per the books, you will find that there is close to 700,000 difference. So this is what is the financial statement level risk of material misstatement. They modify the financial statements superficially. Once the TB is generated, there are some modifications that are made superficially just to ensure it is tallying, or just to ensure that some uh, overall modifications are made to make the books of account look good. Okay. So the risk could either be at the assertion level or it could also be at the financial statement level. Now, till now we were only at the identifying part. Now we will come to the assessing part. You have identified what are the risks of material misstatement that are possible. All of this guidance was to help you to understand what exactly are the areas in which you might find these risks of material misstatement. Now they are trying to guide you as to how to do that assessment. What are the areas that you need to look into? Just a minute. So what are the areas that you need to look into? So first, that is where we come to the aspect of components of internal control. These five components, it is easy to remember by using the acronym CRIME, CRIME, but that is not the order in which you need to remember this. You need to go by step. Okay, but for the purpose of easy remembrance, I have used this acronym called CRIME. So, what exactly are internal controls, Abhinav? For any and every transaction that is happening in the organization, it has to start somewhere, it has to be reviewed by someone, and it has to be approved by someone. The person initiating the transaction and the person reviewing and approving the transaction, they ideally cannot be the same. If everything is being done by the same person, can you find out your own mistakes? Most of the time, no. We know where we can do mistakes. We still continue to do that mistake either because there is no time or there is because we are lazy. There is two of these possibilities. Either we are too held up or we are lazy. To both of them ultimately result in the mistake. Or we want to commit some fraud, so obviously that is also one another possibility. So there must be someone else apart from you who has to review what is being carried out. Every single entry, every single transaction that is happening in the organization must be reviewed and approved by some other person. This is what is called as delegation of authority. Delegation of authority, Abdina. The person who needs to review, the person who needs to approve will be assigned by the board of directors. Okay, you can see it here. Okay, this is something that we can use. This we are talking about something which is very large scale organization, but when we look at something that is very small organization, we may not have this much level of requirement. If you're talking about a very small organization, there will be 5-10 people. Within that, it may be difficult to delegate the work very clearly between everyone. But then, once there is an organization, there will be minimum 2 people. So the person who is doing the work cannot be the one who is approving the work. So there must be always another person who is actually sitting and approving. isn't it? So that is what is this delegation of authority. So you have so many people generally in an organization, you have so many people. So it all starts with the base level employees, and then you have some higher level employees, and then some higher level, then supervisors, department heads, you have divisional managers, senior executives, and managing directors. This is kind of generally the way in which most of the organizations are established, isn't it? So whenever any transaction is there should be somewhere around here in the lower management, there or in the employee operational level, there should be some accountant who will be initiating the entry. The person who is initiating the entry cannot post the entry. This is possible in Tally also. You can do it as in a simple accounting software like Tally, where the person posting the entry and the person approving the entry cannot be the same. So the person approving the entry will either be the finance manager or the CFO, depending upon the nature of the transaction, depending upon the nature of the account that is being hit. So for a base level understanding, I'm trying to give you an analysis of what exactly the internal controls are. Internal controls at a very basic level, this is what you can understand it as: a delegation of authority. The person who is approving and the person who is reviewing and the person who is preparing and the person who is approving cannot be the same. This ensures that the mistakes are reduced, because when there are two people, there will be two set of eyes looking at the same transaction. Naturally the person approving will ideally have some experience, will ideally have some professional superiority, so they will know whether this accounting entry is correct or not. Mostly the managers will be either chartered accountants or BCom with a lot of 10 years, 20 years of experience in their field. So obviously they are more well versed with the accounting entries than a person who just started off, isn't it? So there might be some silly mistakes, or there might be some organizational change that might be required with respect to the accounting entries. So the person reviewing, the person approving will suggest the changes, and accordingly the accounting entries can be made. This is the internal control at a very basic level. Now think of something like assets, physical verification of inventory, physical verification of assets, tagging of assets. All of this is called as safeguarding of assets. You need to buy insurance for protecting the assets. The assets are what are the base for any organization. So you need to figure out ways to protect them. It could either be physical security or logical security. Physical security na MD, all this Tata, this what is that? Infosys, you have Cognizant, you have TCS. All of these IT companies, the assets are mostly their software and their servers, their computers. So you cannot just leave them everywhere, isn't it? There should be proper entry level access. There should be employees wearing ID card to get access inside. There should be proper scanning of the ID card to get inside. All of this is very, very compulsory. Otherwise, you may find that some random people are entering the organization and they may damage the asset. TCS sometimes even goes to the extent of not allowing the phone inside some particular areas. They don't allow the employees to take the phones also. That is good for the organization. So because there may be some critical data that might be happening over there. So when an employee is using those phones inside those critical areas, we are we tend to take photos, we tend to take pictures of everything. This happens even with the recruitment process also. Some critical processes, when people are recruited, you should not post that in the social media. Now, I recently heard one case where Cognizant, there was an interview and there was a assessment. and that person has posted in the social media that I got hired to this particular post and result. They have posted a screenshot of the offer letter itself. So immediately cognizant taking away this offer, because you need to be responsible when you're trying to get into such a post and a position, and that particular role where it is critical that you maintain the secrecy. But unfortunately he has posted in the social media, immediately they took out the offer from him. So these are something that are called as safeguarding the asset. You need to have controls in place to protect your organization, you to protect your assets. These are also called as internal controls. When you try to protect the asset, you can protect an asset in various ways. You can have verifications like this: background verification, it is protecting your employees and people. Having a physical safeguard, that is lock and key mechanism, having security access, giving employee ID cards, all of this is also safeguarding the asset. And then you can have the insurance, buying insurance against the building, buying insurance against petty cash, buying insurance against inventory, buying insurance against your main assets. Everything is trying to protect the asset. That is also called as internal controls. Next, you can think of liabilities, having a proper documentation in place, having the proper manner in which those documents are stored in the organization. All of this becomes internal control. Anything and everything the organization does to protect the organization, its assets, its liabilities, its activities, everything. Anything and everything they do towards the protection and identification of this entity as a whole, the organization as a whole, it becomes an internal control activity. For from a documentation perspective, it could be verification, it could be reconciliation, it could be a physical verification report, it could be some expert level report based on which the accounting entries are posted. All of this becomes your internal control. Now, where are we? Yeah. So when you're trying to understand the internal controls surrounding that organization, the first thing that you need to see is the entity's control environment. First, you understand the environment before you jump in. First, you understand what is the control environment established in that organization. What do I mean when I say the word control environment? Abdina, first of all, does this organization have internal controls in place? அதுக்கு வந்து ஒரு பேசிக்கான அனாலிசிஸ் என்ன பண்ணலாம் அப்படின்னா, ask for policies and procedures, SOPs, policies and procedures. நான் ஒரு document, can I share this document? Let me see if I can share that. I just recently worked on one SOP which, just a minute, I'm trying to find that document. Okay, I can at least show you something that was already prepared. Okay, let me share my screen. Okay, so this is a PPE, that is the fixed assets policy that this organization has. So if you can see here, each and every single activity is being defined. How to initially recognize the asset, how to capitalize, how to de-recognize, how to depreciate, how to treat the leases, how to create the fixed asset register, the verification of assets, the insurance, every single activity, and then the maintenance data, as in how to create the master data, what are the forms that you need to do at the time of creating the fixed asset. Everything is being defined in this policy. See here, all the employees are being defined, then the vouchers, the accounting entry related abbreviations, everything will be there. Then they will define as to what exactly becomes a property, plant, and equipment. It all comes from the standard, but what will really change is the policy. This is the process. This is how the activity starts in that organization. This document specifies that this is what needs to be done. See here, it specifically says maintenance of FFE master data. That means in the register, the PPE register, how to maintain that. The accounts payable accountant, he is the responsibility. What is the task? Receive supplier invoice, and if there is a new vessel purchase or if any single item is above 10,000, then this guy is the one who has to act upon it. That means unless there is a invoice that is coming to the accounts department, they don't have to act upon that. Only when there is there is a tax invoice that is coming to the accounting department, they need to capitalize that in the books of accounts. They say not just a capital, not just a capital procurement, but also an operating asset beyond 10,000 can also be capitalized as a asset in the books. So this policy is making it clear that anything beyond 10,000 is material for this people. Anything beyond 10,000 is a material value for the asset, is what they are clearly defining in this policy. Now, even the operating expenditures, not just capital procurement, but also an operating expenditure that you incur beyond 10,000 at once on any particular vessel. Vessel அப்படின்னா ship. So any particular ship needs to be capitalized அப்படின்னு clear சொல்றாங்க. So this is what is called as a policy. Okay. So this policy will be there for each and every organization. So that is one of the basic thing that establishes the internal controls in an organization. That is one of the basic thing that establishes the internal controls in an organization. So when we are talking about entities control environment, the very first thing that we need to see or look for is whether the organization has these basic controls in place, whether they have those policies and procedures in place, whether they have a delegation of authority. Delegation of authority is also important because if you see most of the organizations in the annual meeting, the board of directors, not the annual general meeting I'm talking about, internal meeting, they will do one review whether the banking approvals should remain with these people or should we give to someone else. This review happens, and if you're taking or considering a large scale organization, the authority of approval changes from one head to another head on a regular basis, every 2 years once or every 1 year once. When the employee size is very large, then they keep shifting the authority between various managers. But if the employee size is small, then they will try to retain it, but they will try to change the way in which the approval comes. First this manager, then the first the accounts manager, then this thing, the procurement manager in the first 2 years. After that, maybe the first the procurement manager, and then second the accounting manager. So this way, they keep changing these approval requirements. And this approval requirements, the delegation of authority is communicated to the banks. The banks along with the specimen signature அவங்க வந்து கொடுத்து அனுப்புவாங்க. So whenever you are approving any transaction online or whenever you are signing any check, the bank will check against this delegation of authority signed by the board of directors. Sign on the document check பண்ணுவாங்க. So only if the signatures on the check match the delegation of authority, only then they will approve that check. அந்த delegation of authority ல எப்படி இருக்கும் அப்படின்னா, for the first 50,000 rupees, finance manager can approve. For the next 50,000 rupees, abdina 50,001 to 1 lakh rupees, finance manager and purchase manager can approve. Adhukaprama, from 1 lakh to 5 lakhs, the general manager also needs to be taken. The approval needs to be taken. Abdina, இப்போ you are issuing, let's say you are issuing a check for 1,50,000. First, finance manager is needed because 50,000 and above, finance manager is needed. For all levels, basically, finance manager is needed. Next, for 50,000 and above, purchase manager is needed. 1 lakh and above, GM is needed. So all three of them need to sign on the check. Okay. So all three of them, only when they sign on the check will get passed. You might ask, sir, three people signing on the check, there is only one slot. Yes, three people can sign on a check. I have seen even organizations where 5 people sign on a single check. Only then the check will get cleared. So this is something called as delegation of authority. All of these things, basically the reconciliations, the verifications, the signatures, the documentation, the what is that? Reconciliation, verification, whatever you do, anything and everything that you do in an organization to ensure that correctness, to ensure that proper outcome of that organization, even for that matter, even audit also becomes an internal control, because we are coming and verifying if there are any mistakes are there, if whether the entity is accounting properly or not, everything we come and check. So even we become an internal control, because we go in there and do that verification and check and ensure they do the corrections once we find out any mistakes, isn't it? So what was wrong is getting corrected. What was initially a risk of material misstatement is getting corrected once we are highlighting that to the board of directors. So the internal control basically could be anything and everything that is helping the organization have an effective and efficient policies and procedures and activities in place. So this is what is the entity's control environment. Whatever they are trying to do with respect to their assets, with respect to their liabilities, with respect to their entity as a whole, to protect them, to ensure they are operating as per the requirements, everything the company does is called as the entity's control environment. And the very basic document that proves that there is controls in the organization is the SOP, standard operating procedures. About the document that I just showed you, I just showed you one small area of a fixed assets, that's all. But for every single branch of the organization, there will be a clear policy. If there is a purchase department, there will be a procurement policy. If there is a finance department, there will be a complete accounts and finance manual. If there is a sales department, there will be a sales policy which will define as to how what is the role of the sales executive, what is the role of the sales supervisor, what is the role of the sales manager, what is the role of the sales director, what is the role of the sales head. All activities, every rest role and responsibility, everything will be clearly defined in that policy. Okay, so that basically is your control environment. So now you have established one control environment in place. Now this is what you need to compare the actual performance. The SOP says there is every capital asset or every operating expense that is beyond 10,000 dirhams needs to be capitalized in the books, is what the policy says. That is the control environment. You have established this control environment through this policy. Now, when you go and audit, you will check whether this has actually happened or not. You will first take out all the operating expenses beyond 10,000 and see whether all of this has been capitalized or not. So, if they have capitalized, it is good. If they have not capitalized, it becomes a risk of material misstatement. It is material because the policy is defining that this is the limit. Beyond this, it becomes critical for the organization. So the policy itself is telling that this is the materiality level for the operating expenses. So then, based on this control environment, based on the policy document, you try to check, like I said about the delegation of authority. For approving the vouchers, some level of authority will be there. For signing the checks, some level of authority will be there. So when you are actually checking the expenses, you will check, okay, first 50,000 expenses, finance manager has the approval. Next 50,000, the finance manager and purchase manager, both signatures are needed. So when you are actually checking the expenses, you will check, okay, what is the amount? How many signatures are there? Are they belonging to the finance manager and purchase manager or not? So this way, when you are auditing also, you can have a check based on what is established. What is established is called as the entities control environment. Based on that, when you do the actual risk assessment, that is what is the next point. When you are doing the actual risk assessment, you will get to know whether there is any issues or not. So first you establish the entities control environment. This is the point. And then you go to what is called as the risk assessment. Based on the control environment, you try to establish whether the actual practice in the organization is happening as per the policy or not. Now, next is the control activity. If it is not happening, why is it not happening? Why is the control not working? Andradum பார்க்கணும். ஏன் அப்படின்னா, I have seen in the case of one bank, அவங்க வந்து the management has bought in a new change, a new form that was required to be entered by the bank managers, I think, bank managers or tellers. The tellers had to fill one form at the end of the day, every day. Okay, and this was pretty much a organization-wide requirement, and we have seen that very few branches were complying with this requirement. And this has come directly from the board of directors, but very few branches were complying with that requirement. And when we had seen which branches were they who were the ones which were complying with it, we realized they are the ones which are very small in numbers, very rural ones, or very the ones in the towns are only the ones which are actually complying with this requirement. Why the people in the urban area are not complying? Abdin Pata, the tellers already have so much of work. Beginning of the day, end of the day operations, it takes a huge significant amount of their time. And then on top of that, their regular work is there. So if you burden them with silly forms at the end of the day, it will become a pain in their for their regular operations than helping anything. So they completely stopped doing that process itself. So what has happened is what the bank wanted to look at as a control for certain things has resulted in a more workload for the employees. Okay, so because of this, they were not willing to carry out that activity at all. So this is what is the control activity. There may be some policies and procedures that might be established in the organization, but the company may not actually follow them. The company may follow some other procedure. The company may be actually having some other procedure. Either the policy is not updated, or the ground level people are not aware of the policy. Both things are possible, and both things are equally a reality in the current world. The policy will be there, but people will not be aware that there is a policy. Okay, the policy is there, but the actual procedures are different from the policy that is drafted. So the control environment is where you need control activity is where you need to see whether the policy and the actual activities are they in line or not. So when you do the risk assessment, you know where the differences are, where the deviations are, and then in the control activity, you try to establish that these are the things. You do a verification of the controls. Like I said, the delegation of authority, these are the people who have to approve. So when you are checking the vouchers, you will check whether these people have approved or not. If they have approved, well and good. If they have not approved, it's a deviation. So you establish that as a deviation from the controls. So that is what is the control activity. Next, monitoring the controls. Monitoring the controls basically means once these controls have been established, the board of directors are the ones who are responsible for the oversight and establishment of internal controls in any organization. So they need to have a clarity that the controls are operating in the manner in which they should operate. Abhina, once you have put in a policy and procedure, you are the person who has put in those policies and procedures. So you need to be made responsible to ensure that those policies and procedures are working, isn't it? So when the bank management is putting in some policies and procedures, they are the ones who need to ensure that these policies and procedures are followed by everyone. So monitoring of controls under the one there, when you are establishing those new controls, the new changes in procedures, new activities, new forms, new signature requirements, new reconciliations, new verifications. Whenever you are trying to define something, you also need to ensure that it is actually working. How do you ensure? Through audits, internal audits, or through internal verifications, or through external audits, or through some other it could be an audit, it could be an ISO requirement, ISO audit, IT audit, whatever it could be. The tax audit. There are various ways in which you monitor these controls in place. There could be a process audit. There are a lot of ways in which you can establish this. It could either be internally done, or you can hire some external party to ensure that these controls are actually working. And finally, information and communication. For any control to work properly in an organization, this is must. The communication must. What I personally observed in my experience is that in a workplace where the accounting software is very good, in a workplace where the documents are shared through an IT software, and where the software is really good, in those places I've seen that the employees are much happier, employees are much willing to work in that organization. Because what happens is the software is so good that it takes care of majority of the requirements. Okay, there is no reason for conflict. Even if there is an issue, they can simply highlight and send it back to the previous person within the software itself. Even if there is any problems or anything, the software makes their life easy in resolving it or in taking it forward. So the software plays a major role when you're dealing with a huge number of transactions. Currently, none of the organizations have minimal transactions. Even a small scale organization deals with a huge number of transactions. So when you have that proper software, it could be an accounting software or it could be an operations software. Now, if you take something like SAP, they are not just accounting, they have the operations in place from where the documents will flow to the accounts also. It could be HR, it could be actual operations, it could be inventory, it could be the sales team. All of these will be in one single software. All the teams will operate out of one single software. And if that software is really good, I've seen that the controls, the work ethics, the happiness of the employees, everything is really high. The policy that I just showed you, even that organization, I was very surprised because when I went to that organization, the employees are very, 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 very friendly, and each and every one of them was friendly. They were actually very productive in their work. They were very, very productive in their work. So it made me kind of realize that my thought process about the software is very appropriate because these people had a very, very good accounting software as well as operation software. So when all of the information is being communicated as required in a properly timely manner, in the established format, when all the controls and procedures are working as per the requirements of the management, in such an instances, the possibility of the risk of material misstatement is very low. These risks are what you're trying to mitigate. So when you have that proper communication channels established, the proper formats and documents for communicating that information is established, then also the risk of material misstatement can be reduced. So these are the basic components of the internal control. The first one is actually the control environment, out of which the control environment is the document, the SOPs, the delegation of authority, all of this the management establishes for the people in the company to follow. Now, based on this, you do the risk assessment, whether the actual activities and the SOP, what the SOP says and what the actual activity is, you compare and see whether it is working as per that or not. If there is any deviation, then you refer to the control activity. If there is a compliance, then well and good. If there is a deviation, then you do look after the control activity. Whether this control is actually good for the organization, whether this control is required for this particular activity, whether this control is causing benefit or whether this control is creating more trouble. All of this thing you need to verify, and then you need to suggest some change in the control activity. When the management approves the change and the new control is established, you need to monitor that control. When I say you, not as an auditor, you, but the management needs to monitor whether that control is working or not. Otherwise, again, it becomes like the same previous one. It will not yield any benefit. Now, think of this: there is a toll gate. Now, in this toll gate, there is a risk of the money being stolen. And it happens quite a lot in India. Many of the toll gates which are managed by NHAI, there is a possibility that the money gets stolen. They know because most of the toll people working inside the toll will be local people only. So the MLAs will create a big ruckus and they'll say you're taking away our farmlands, everything. So we need people from this area to work inside the toll booth. Well and good. All the people working in the toll booth will be the locals only. So when all of them are locals, obviously in villages people know each other, right? And In such a situation, there is a possibility that these people might be looking at the amount of money that is getting collected, and they'll say, okay, I think we can try some theft, we can do something. They do attempt robberies and all. So they know at what time the manager will come to collect the money. There will be fixed timelines to come and collect the money, all of that. So when this happens, people will suddenly walk in with rifles, they'll suddenly walk in with jeeps with high speed, everything. And all of these scenes happen across many of the toll booths in India. Now, when this issue is there, you need to resolve it somehow. So let's say there are multiple ways to resolving this. First is you can either have a security guard, okay? You can either have a security guard who will try to protect you while you are carrying the money. That is one of the simplest things that you can do. The same activity of collecting the money, I'm giving you examples as to how many levels or how many different types of controls you can establish. One is you can have a security guard. Second thing is what L&T does with their toll gates. L&T, what they do is they create an underground tunnel. You cannot take the money from above the road. Once the teller is asked to drop the money, what they have to do is they have to count the money and they have to simply drop it in one hole beside them. So once they drop it in that hole, the hole will get closed. That's it. No one can access that money. So even if there is any robbery or anything that is going to happen, they simply say drop the money in that hole and you escape. Okay. So when they drop the money in that hole, simply what happens is no one can touch the money. No one can access it from outside the toll booth. You have to go inside the toll booth of the L&T. You have to go inside the main office. Only from there will be a secured access to those tunnels. So this is one way in which you can control the flow of money. The third thing that now recently the government has come up is the fast track. What is fast track? You digitize everything. There is no physical currency that is exchanged at the toll booth. You digitize everything. Now, isn't the risk of the robbery reduced? Yes, because when there is no physical currency, the robberies will automatically be gone because there is no physical currency to rob. What will they do? Isn't it? So the very same aspect of protecting the money, there is some robbery happening, that is the risk, and there is some control suggested. One is having a security guard, one is creating a tunnel, one is digitizing everything. All three are controls, but at the same time, we need to understand that there is a cost factor behind these controls. One, hiring a security guard is a matter of 15,000, 30,000 rupees per month. Okay. Now think of the other one, creating a tunnel. You need to create an entire bloody tunnel under the toll gate. When you create an entire tunnel and below it, there is obviously a lot of cost you incur when you're doing the toll booth construction, isn't it? You cannot just have a tunnel just like that. You need to have, again, the tunnel needs to be protected, the entry exit needs to be protected, there should be a proper drop mechanism. Once the cash is dropped, the door should get automatically locked from outside, it should not be accessible. All these mechanisms also must be done along with that tunnel, isn't it? So the tunnel doesn't come cheap. Now just imagine they are spending 10 lakh rupees for this particular thing, this particular control to be achieved. And then there is another control which the government has brought now, which is the fast track. Now fast track is not something that just happens on a single day. It requires crores and crores of establishment behind that fast track software, behind those fast track servers, behind those SOPs. First, the SOP must be defined by the uh, the government of India, and then they need to submit it to the RBI. They need to submit it to one crime organization. and then all the inputs needs to be taken, the NHAI, everyone needs to be consulted, and then this software will be ready for development. Then the software people will be hired, software is developed, the base is created, the servers are created, a lot of infrastructure is established. Just imagine, single thing that they are trying to eliminate, they are trying to eliminate the losses to the maximum extent possible, and for this so much of money is required to be established. So it always depends upon the situation as to how you will implement the control. Either you go with the 30,000 guard, 10 lakh tunnel, or crores worth of software. If the company is able to do that, they will go with the bigger amounts, because in the longer run they will have the benefit. But if they are not able to do, they will have to make do with the smaller controls. Okay, they will have to make do with the smaller controls. Once these controls are established, they will see whether this is working out or not. Why? Because think of Naxalite areas, think of areas where there is a big time issue with respect to Naxals, or with respect to troublesome areas where we constantly hear about Naxals in borders, the forest regions of Andhra. Then you have Odisha, Jharkhand. What else? Jharkhand. Yeah, almost all these regions you have a lot of Naxal issues. And then think of the Bihar areas. We naturally hear a lot of times that there are a lot of people roaming around with guns in Bihar. And this is a real issue I've seen in L&T, that in Bihar, if they have any toll, they sometimes go with a vest. They sometimes go with a life saving vest for the office, because they know that the tensions are high and people might be roaming around with guns, and bullets will be flying around, because people are crazy and bullets will be flying around. So they actually need to go with a life saving vest, it seems. And I've heard stories about employees getting saved because of the life saving vest and all. So even though you have a security guard in place, it may not be really effective for that area. Okay. So even if it is costly, you might still have to consider the tunnel option, because if you don't do that, you are losing people and you are losing money, isn't it? So this monitoring controls is actually how this whole of process. You don't just identify any random control. Even with respect to tolls itself, I can suggest you one more thing. Now, all of this money that is getting collected, it has to be stored at one particular place. Okay. And the access to that particular storeroom is with three people minimum. Two or three people will be having the access. And you know the best part of it? The best part of it is that they all need to physically be present for opening the door. One has the smaller key, one has the bigger key, one will have the electronic card. All three of them have to do it simultaneously for the door to open. Otherwise, the door will not open. So you need to bring all three people together with all of their access cards to ensure the door is opening. One will be a physical, one or two will be a physical key, and then the third one will be a electronic key. So this will ensure that the cache is safe. Okay. But there are other controls also that you can put to this. What if all three of them come together and try to steal the money? Possible. Humans, it is natural that people can come together. They are all employees of the same organization, so they might do that also. Very much possible. So in order to avoid this, there are various things that the organization can do. One is hire these you see these people called bricks who supply money to the ATMs. If you remember, they will transport the money from the bank to the ATM, isn't it? So similarly, from the toll gate to transfer the money to the bank, these people will come, these bricks people, or these people with these specified trucks will come for taking the money. Now, from the from that safe till the time you unload the money onto that truck, the responsibility lies with the organization. Now, how do you tackle with this? So, in one instance, I have seen the auditor has said you need to install a double door system அப்படின்னு சொல்லிட்டு இந்த ஃபாரின் கண்ட்ரீஸ்ல இருக்கிற SOPs எல்லாம் படிச்சு இந்த ஃபாரின் கண்ட்ரீஸ்ல வர ரிப்போர்ட்ஸ் எல்லாம் படிச்சு he simply suggested you need to have a double door mechanism அப்படின்னு சொல்லிட்டு ஒரு பப்ளிக் ரிப்போர்ட்ல போட்டு வச்சாங்க. அதுக்கப்புறமா the board of directors called that auditor for a meeting and scolded him left and right. They said, do you really realize how much cost the double doors cost? Because when an auditor says something, people take it seriously. Okay, you cannot just like that behave when you are in a professional capability. You cannot just like that make statements. The once the auditor makes this statement, people will wait for it. Okay, where is the double door mechanism? Has this been implemented? Has these changes been implemented by the organization or not? All of this people outside, not just the government, the investors also monitor. So the management has called that particular auditor and blasted him like anything. They said a double door mechanism will cost us close to 60 to 80 lakh rupees. Do you really think we could have that establishment at a toll booth? Because the daily collection of that toll booth itself was to somewhere around 10 lakhs, 10 lakhs, 20 lakhs. So, with such a small scale revenue, do you think having a 60 lakh, 80 lakh double door mechanism will really work? Most of the revenue that they are earning is going towards that double door mechanism only. Then leave the protecting of the asset. But if you are spending so much on simple safeguarding of assets, it is kind of pointless, isn't it? So that is what monitoring the controls is all about. It is not just trying to establish the right control, it was also monitoring as to whether that control is cost effective and whether that control is actually working or not. So both of these things you need to see. And finally, the information and communication, like I said, the forms should be proper, the emails should be proper, the asset registration form, the capex request form, the operating expense request form, petty cash voucher, the bank payment request அப்படின்னு சொல்லிட்டு இந்த மாதிரி நிறைய ஃபார்ம்ஸ் இருக்கலாம். So all of this, the journal voucher, the stock voucher, the stock request, stock issue, stock purchase, purchase requisition, PO, purchase invoice, sales invoice, எல்லாத்துக்கும் ஒரு format வைக்கலாம். So all of that formatting, all of that communication channels, establishing everything in the organization, this becomes your information and communication. So internal control அன்றது வந்து it's not a simple thing. It's everything and anything happening inside the organization to establish a standard procedure. Okay. So first is the environment. Environmentல வந்து you do the risk assessment. The environment establishes what must be done. Then the risk assessment, whether the risks, all the risks that are faced by the organization are covered by the policy or not, whether the policy and the actual procedures are matching or not, which one is not matching. Is it the policy which is outdated, or is it the procedures which are not following the policy? You need to establish. Then you need to talk about the control activity, whether the controls are being followed or not. When you talk about the risk, the very thing that controls is the control. The risk is reduced by a control. Any activity that you do to reduce the risk is basically a control. I was talking about having a security guard, I was talking about having a tunnel, I was talking about the FASTag. All of these are activities which are reducing the risk of theft of physical cash. So all of these become control. You try to verify the petty cash at the end of the month, verify the physical balance with the book balance. The possibility of any wrongdoings with respect to the petty cash are nullified when you do the physical verification. So that is a control. So control is that process, activity, or a report, or a signature, or a verification that can help you establish that the policy or the process of the particular event or organization or department is happening in the way it must be. When junior level guy does all the entries, the senior level guy will review and approve it. So there is a control that this accounting entry is proper. What is the risk there? The accounting head might not be proper, the amount might not be proper, it may be proper posted in a wrong period. All of this the senior will check before approving. So when the senior checks, there is at least some level of guarantee that the risk has been reduced, the risk of wrong things has been reduced. Now the senior will prepare the financial statements and submit to the manager. The manager will check whether the financial statements have come out correctly, whether it is as per the trial balance, whether it is as per matching as per the books or not. The manager will then suggest changes, whether it is as per Ind AS or not. All of this the manager will check and suggest and take the approval of the CFO. Now when some multiple people have checked and verified and approved, obviously there is better you know better understanding, or you can say you can have a better what is the right word, guarantee, satisfaction. You can have a satisfaction that at least some level this all of this verification has happened. So there must be minimum number of risks that are there in this process is what you can have in mind. So this is what is with respect to the internal controls and the components of the internal controls. I have given the acronym crime for you to remember them easily, but the order in or mechanism in which you have to read is first the control environment, then the risk assessment, then the control activity, then monitoring controls, and finally the information and communication. So this is with respect to SA 315. Just give me a 2 minute break. Okay, so let's start with the next standard, which is SA 320, materiality in planning and performing an audit. I have given you the base definition of what materiality is and how it works. So we'll just quickly go through this standard to establish what is required of us by this standard. So first one, they define the concept of materiality. They say, I will increase the size. Okay. So first, they talk about the concept of materiality. This standard is defining what is materiality. Materiality is a subject of professional judgment. This is very important. It is a professional judgment. It is subject to the professional judgment. That means auditor to another auditor, one person to another person may define a different materiality level for the same organization. So it is always a matter of professional judgment as to what they want to consider as materiality level for that particular organization. Is a subject of professional judgment and discussion presented in FRF and provides a reference to the auditor in determining materiality. So you may discuss about this. The basis for this might be coming from the financial reporting framework, FRF அப்படின்னா financial reporting framework. The basis for this is coming from the financial reporting framework because these standards also become part of the reporting framework. They are providing a basis for establishing the materiality of those financial statements. So accounting standards, auditing standards, everything becomes part of the reporting framework, provides a reference to the auditor in determining the materiality. FRF is providing the basis, that this standard is basically providing the basis, and based on the standard, the auditor is trying to establish a materiality level through his or her professional judgment. So if FRF does not include a discussion, like think of the policy. The policy has said 10,000 is the materiality level for the fixed assets. Now, if the policy is silent on it, it's not necessary that every company policy will have that. So if the policy is silent on it, what do we do about it? They say these are the indicators. So, like I said, materiality is a very relative number. Big, high, low, soon, long. These are all very relative numbers. The long for you and the long for me might be different. The high for you, the high for me will be different. The speed that which you are comfortable with in driving a bike and the speed at which I am comfortable driving a bike will be different, isn't it? So since it is a relative number, it is not a fixed number. What we need to do is we define aspects around it so that we establish or come to that. So first let us see. Misstatements, including omissions, expected to influence the economic decisions of the users. So if there are any misstatements or omissions which are expected to influence the economic decisions of the users, if you remember in one of the previous classes I was telling, if there is a particular class of end users who are particularly interested in the environmental sustainability of the organization, the organization has said we will spend 10, we will plant 10,000 trees, but if they have not planted, those set of investors will not invest in the organization. Believe me, it is a significant thing because there is a set of group of investors these days who are investing only in those organizations which are environmental friendly. Even if it is not giving good returns, also still they are not bothered. Their primary concern is environment. They want the health of the environment. So only those companies which are working towards the environmentally friendly, which have the environmental friendly concerns, only those companies they are investing. So nowadays there is a rating for the economic environmental sustainability rating is being given for most of the organizations. So particular set of end users, this if this particular data set is not achieved, the company says that they will plant 10,000 trees but they have not achieved this, so this becomes material for those people, isn't it? So even though in terms of the whole financial statements it may not matter, but it might become a significant matter for these particular group of investors. That is why they say misstatements including omissions expected to influence the economic decisions of the users, or it could be a particular set of users. For them, if it is material, it is a material number. And remember, there can be materiality levels at multiple places. Overall, as a financial statements, you can simply say, okay, 1 lakh could be the material level. But when you go inside the fixed assets, when you go inside the petty cash, you cannot have the same materiality level for petty cash and fixed assets, isn't it? For fixed assets, you can have a materiality level of 1 lakh. It is understandable, it is common. But for petty cash, you cannot say, okay, till the time 1 lakh for petty cash is lost, it is okay. Even if 1 lakh is gone, also it is okay. You cannot say that for petty cash, isn't it? So the materiality level differs from item to item in the financial statements. Next, size or nature of misstatement and the surroundings. This they say, if there is a misstatement, then based on the nature and how much impact that misstatement has, then you can decide whether it is a material amount or not. If you remember, I was talking about a set of entries which added up exactly to 1 lakh 50. Okay. Even though it added up to 1 lakh 50, it wouldn't have made a major impact for that organization because it was not a very significant, actually speaking, it was not a significant amount for them. But there is a legal aspect to it. But there is a legal aspect to it. What is that? They have bribed a particular officer of a government entity. Now, what has happened is that because of this, there is a legal issue that has come up. Okay. Now, what is happening? Amount which ideally was not material has become material for them because of the nature of that misstatement. Okay, because of the nature, it was not because of the size. It became material because of the nature. They bribed someone in the government entity. Okay, now initially it was not a issue, but in future this has actually happened. The government officer was caught, and all the companies which bribed him, they were all given a big penalty to pay. Okay. So what was technically a 1 lakh 50 has resulted them in them paying almost close to 10 to 12 lakh rupees. Now what is happening? A small misstatement for that company. Ideally 1 lakh 50 was not a big deal. But because of the nature, the legal circumstances surrounding that misstatement, it has become material. Even when we highlighted, it has become, even when we saw it, we have highlighted because it was a legal instance here. So based on the nature, we have said that this is a material aspect. In future, when the guy got caught and these companies were fined, even then it has proven to be a material aspect because of the legal circumstances surrounding that transaction. So it is not necessary that it has to be purely based on number. You need to consider the circumstances as well. Third point, common financial needs of the users as a group. That's what I was telling about the First and third point I've mixed and talked about the environmental requirements. So if you're not able to directly arrive at the materiality number, these are some of the guidelines that you can refer to. Following can be referred. It is only a referral guideline that they are giving. Okay. Next. Now the standard has defined what is the materiality. Now there is something called as performance materiality. There are two types of materiality. One is the materiality that you define at the time of the audit plan, SA 300. At that time, you define one materiality. Now, for the actual activity, the actual audit that you are going to do, what the materiality that you define becomes the performance materiality. Like I said, for the fixed assets, you can have a 1 lakh materiality, but for the petty cash, you definitely cannot have 1 lakh materiality. You can maybe say have a 10,000, 15,000 materiality. That makes more sense for the petty cash, isn't it? So performance materiality under the one, based on the item of financial statement that you are auditing, you need to modify the materiality level. That becomes your performance materiality. So let's read. The amount set by the auditor, at less than the materiality for financial statements as a whole. I said 1 lakh is the materiality level for the financial statements as a whole. But when it comes to petty cash, I cannot have the 1 lakh to less than materiality for financial statements as a whole. I need to reduce it to 10,000. Only then it makes sense for that particular item, for the petty cash item, isn't it? And then maybe think of inventory. Inventory la vandu I have lot of items which are costing around 20,000, 25,000. So when the item cost itself is 25,000, I cannot say that 1 lakh is the materiality level, isn't it? So even if some inventory is missing, it will still be a significant portion for me. So I cannot have that 1 lakh for the inventory. I need to again reduce it to reduce to an appropriately low level. So based on the item of financial statement, it might be either reduced to an appropriately low level. The probability that the aggregate of the uncorrected and undetected misstatements exceeds materiality for financial statements as a whole. Okay. So I need to reduce it to such a low level that the probability of the aggregate and uncorrected and undetected misstatements, மிஸ்டேட்மெண்ட் அன்றது வந்து நம்ம கண்டுபிடிக்கல இல்லைன்னா அவங்க கரெக்ட் பண்ணல, ரெண்டுமே வந்து மிஸ்டேட்மெண்ட் தான். இட் கேன் பி ஐதர் இன்டென்ஷனல், அன்இன்டென்ஷனல், இட் இஸ் கரெக்ட், incorrected, uncorrected or undetected. It could be anything, but as long as the mistake is there, it is a mistake only. It is a misstatement only. So what is happening with respect to the inventory here is that I'm telling that there is a inventory worth of 25,000. Okay. So if we sit at 1 lakh level and say, okay, 4 items தானே போனாலும் பரவாயில்ல அப்படின்னு சொன்னா, it may be 4 items today, but in future, even though they are small in number, small in size, if you just take a few away, என்ன ஆகும்? Aggregately, individually, they are only 25,000 worth. But when you combine 5 of them, it becomes 1,25,000. Or otherwise, if you remember the uh, bank fraud that I was talking about in US, once every single transaction, that guy was transferring 0.000000001 dollars. Okay. But just imagine, on a daily basis, there are lakhs of transactions happening in the bank. And on a yearly basis, just imagine the total number of transactions that can happen. And that guy became a millionaire in a few years. Okay. That guy became a millionaire in a few, not years, I think months, I think. So just imagine, individually it is not significant, but when you combine it as a whole, it becomes a big issue. Okay. So the performance materiality is that materiality materiality, which is set by the auditor at less than materiality for the financial statements as a whole. 1 lakh lande na 10,000 vanditen for the petty cash and 25,000 for the inventory to reduce to an appropriately low level so that the probability that the aggregate of the uncorrected and undetected misstatements exceeds the materiality for the financial statements as a whole. Other one we need to consider. If individually it may be low, but when you accumulate it, it may become which it may become a number which is exceeding the materiality for the financial statements as a whole. ஒரு 5 inventory pieces போச்சு அப்படின்னா 5 தானே அப்படின்னு விடக்கூடாது, because 5 into 25 is 1 lakh 25, which is exceeding the basic 1 lakh limit that we have established for the financial statements as a whole. So the performance materiality depends upon two factors. One is the item that is being audited. You may need to reduce the materiality for that item. And second thing is the aggregate nature of those material misstatements. If you accumulate them, if they are going beyond financial statements materiality, then for that particular item, you need to come down and see at an appropriate level. Other performance materiality. First, we define the normal materiality in SA 300 at the time of planning the audit plan, audit strategy, audit plan. We define one materiality level for the financial statements. But when we are actually carrying out the audit, SA 315 முடிஞ்சு போச்சு. Now we have entered the audits. Now we are identifying, assessing எல்லாமே முடிஞ்சு போச்சு. Now we have started with the audits. Now, when we have started with the audits, we come across something called as performance materiality. This performance materiality, based on the nature of item of financial statement that we are auditing, it needs to be modified, lowered, or increased based on that particular item. Auditor's duties. What is the auditor's duties in with respect to this standard? The auditor shall determine the materiality for the financial statement as a whole. Yes, that is what SA 300 was talking about, isn't it? SA 300 la நம்ம இதுதான் டிஸ்கஸ் பண்ணோம். The overall materiality needs to be established for the financial statements at the time of planning, at the time of strategy itself. அதுக்கப்புறமா determine the materiality level for specific lower amount might be expected to influence the economic decisions of the users. So based on the financial statement that you are auditing, that materiality level might have to be reduced. Third, determine performance materiality for purpose of assessing the risks of material misstatement and determining the nature, timing, and extent of further audit procedures. RMM abdina risks of material misstatement, NTE abdina nature, timing, and extent. Based on the the risks of, just a minute, I'm getting a call. Yeah, so based on the just give me 10 minutes, we'll be done with this standard and start freshly with the 400 series in the next class. So what was I talking about? Yeah. So based on the performance materiality that we have established, the policies, the procedures, the audit that we carry out will naturally change. For 1 lakh level, we do one type of audit. We definitely ignore a large portion of the transactions. But when we are taking a lower materiality level, we may have to include a higher sample, the sample size, the sample selection, all of this process will again come in. And the nature of verification we do will definitely vary from inventory, from petty cash, from fixed assets. You cannot do the same verification for all of them, isn't it? So based on that, the nature, timing, and extent of further audit procedures will also vary. Next, they talk about the revision of materiality. There may be a requirement to revise the materiality when first. In event of becoming aware of information that would have caused auditor to have determined a different amount initially, that means they have determined a different amount, but auditor shall revise materiality for the financial statements as a whole if required for particular transactions, for particular classes of transactions, account balances, or disclosures. So initially, based on the information available initially at the time of strategy, at the time of planning, they had one materiality level. But few later on, after getting into the books of accounts, they realized that the policy itself defines a higher materiality level. Okay, the policy itself, the policy documents of the company itself, they say they follow a different materiality level. Okay, if the company itself is comfortable with that, I am comfortable with that also. Abdinta, they can also, the auditor can also revise the materiality level. In some places, what we do is, if the software is really good, if the accounting software and the controls in the organization are really good, then we increase the materiality level. If the, let's say we have considered 1 lakh, we will go up to 1 lakh 50 or 2 lakhs, because if the controls are really good in that organization, if the accounting, if the quality of accounting, if the person who is heading that particular team, if they are really good in those instances, what happens is, there is higher probability that the mistakes will be low. So in such cases, what we do is, we generally take a higher level of materiality, so that we only look at what is really impacting the organization rather than sitting and working out every single minute detail. Okay, so initially at the time of strategy, you have one number, but based on the information, the inputs that you have received later on, you may revise the materiality for the financial statement as a whole. That means you may increase it or decrease it based on the information you are receiving later on. So if the auditor concludes that a lower materiality than the initially determined is appropriate, then the auditor shall determine whether it is necessary to revise performance materiality. So if he believes 1 lakh is no 1 lakh is too high for this organization, in the organization வந்து controls ஒண்ணுமே கிடையாது, we need to come down. இந்த ஆர்கனைசேஷன்ல வந்து ப்ரொசீஜர் சரியா இருக்க மாட்டேங்கிறது, ஜஸ்ட் பேசிக் புக்ஸ் ஆஃப் அக்கவுண்ட்ஸே சரியா இல்ல அப்படின்னா, we need to be more careful. We need to have lower materiality levels so that we can get comfort that at least boss mistakes அன்றது வந்து கம்மியா தான் இருக்கும்ன்றது வந்து நம்மளுக்கு கான்ஃபிடன்ஸ் வரணும் அப்படின்னா, we need to increase our sample size. If we need to increase our sample size, we need to reduce the materiality level. Only when you reduce the materiality level, the sample size will increase, our verification processes also will change. So based on that, the performance materiality will revise. Accordingly, the nature, timing, and extent of the audit procedures will also change. Next, and this is what I've been telling you. Generally, a percentage is often applied to a chosen benchmark. Chosen benchmark, 10% of the fixed assets, that is the benchmark. 5% of the sales, 10% of the equity. It's a common benchmarks as a starting point in determining materiality for the financial statements as a whole. Let's say revenue எடுத்துக்கோங்க, EBIT, EBIT க்கு வந்து you can take maybe 5% or 10%, and say this is a material number for the organization. The benchmark is the EBIT, the sales, the revenue, the equity, the fixed assets, the total of the balance sheet. All of this could be a benchmark. So if you apply some percentage on it and say this is what we are looking at, yes, that could be a materiality level for the financial statements as a whole. That is generally what people do. Okay. Next, the factors affecting identification of appropriate benchmark. So how do we determine what is the right benchmark? Now, think of a company which is which is like Oyo or Ola. They have a huge fleet. Oyo, Ola, Ola, they have a huge number of cars on their service. But do they own any cars? Not a single car. Oyo has a huge number of rooms on their platform, but do they own a single hotel? Not a single hotel is owned by Oyo. Everything belongs to some other person. Okay, these are just acting like aggregators. Okay, in this case, when you go look at their assets, there'll be no assets on their books. There'll be only software on their books as an asset. Okay, so what will happen is if you're trying to establish the asset as a benchmark, it will not be appropriate for an organization like Oyo or Ola because there is no asset base, isn't it? When there is no asset base, you cannot take that as a benchmark. That is what they're trying to tell you. How to identify an appropriate benchmark. We have these factors. First is the elements of the financial statement. What is really having an impact on the financial statements? Where is their major focus area? How are the operations looking? How the information flows across the financial statements? All of this you need to consider. Second, items on which the attention of the users of particular entities financials tend to be focused. Like I said, if it is an IT company, particular set of areas where people look for. If it is a aggregator company like Oyo, Ola, Amazon, Flipkart, these are aggregator companies. When you are looking at them, you don't look at the asset base. You look at the equity base. You look at the liability base. You look at the revenue base. There, it is more appropriate to go with the revenue. Okay, but when you're talking about a manufacturing industry, when you're talking about a manufacturing industry, it is more appropriate to go with the assets than with the equity or debt component in the organization. So that's what they are putting here. One is the nature and where the entity is in its life cycle. Yes, this is a good point. Okay, every single company that is starting up has these phases in its life. Okay, there is a startup phase, and then there is a significant growth phase. Okay, and then there is a stagnation phase, or where you cannot find any significant increase in the revenue unless you drastically change your product. Based on the current product, first you will have that hiccup to get into the market, to establish into the market. First you try to establish yourself. Once you click, there will be a growth phase. Once the growth phase is done, there will be a stability phase, and then there will be a maturity phase where you will have only the people who are already there with you, who extremely like your product. Only they will stay with you. Otherwise, people go for alternatives. So the establishment is trying to go into the market. For them, the materiality levels will be different. For a company which is growing phenomenally, think of Oyo when it started. Within few years, the Oyo was really growing at 2000% per annum. From previous year to the next year, if you see, for 3 4 years, this is the rate at which the revenue was growing, 2000 per annum. So this is not a small number. And even the Zomato, if you see, even I think they have come up with a 4000 crore IPO. So when companies like that are in the growing phase, okay, their numbers are completely phenomenal. From one year to another year, they change like anything. So you cannot establish one materiality level in previous audit and say, yeah, this is the number we can use forever. No, not possible. Because if they are in their growth stage, you need to constantly revise that number. year on year, quarter on quarter also. Next, stability phase. This is where you can have a number and say, okay, for the next 5-10 years, we can have this number. And then the maturity phase, again, things starts going down. You need to again revise the materiality level. So based on where the entity is in the general life cycle, the industry, the economic environment, what are the legal constraints the entity is facing, everything has an impact on how you determine the materiality. Like even the ownership, like I said, equity and capital are also one of the benchmarks. So they say the entity's ownership structure, the way it is financed, and the relative volatility of the benchmark. The volatility, that's what I was telling about. If the revenue is growing at 2000% per annum, from quarter to quarter the materiality level changes, isn't it? So you need to take all of this into consideration for what the identifying the appropriate benchmark. Is it sales? Is it expenses? Is it assets? Is it equity? What should be considered as the appropriate benchmark for determining the materiality? And finally, small point, judgment of materiality provides a basis for what is this whole standard talking about. What will it really help us if we establish a materiality level? Once we establish a materiality level, this is what we can achieve. One is determination of nature, timing, and extent of risk assessment procedures. So at the strategy level, when we establish one materiality level, we can really understand what is the risk assessment activities that we need to do. Which areas are risky? Which areas become risky as per this materiality level? Which areas need a lot of focus? All of this you can determine. Then based on that determination, you can identify what are the activities that you need to do, what are the actual audit procedures you need to do in identifying those risks of material misstatement. It is there in that word itself. It should be material. You cannot consider things that are not having a significant impact for the organization. So based on this, you can also decide what are the further audit procedures that you need to do. Is it a simple voucher verification is enough, or you need to do extra analytical procedures around it? You need to do ratio analysis. You need to do any software usage to determine whether there are any mistakes in that this thing, the ledgers, or with respect to that particular item. Do you need to do all of those? Is it really required? All of these can be established by that materiality. So by having a materiality, this is what is really the end use of it. One is the risk assessment procedures, next is what level of misstatements that you're looking at, and then finally the audit procedures that you need to carry out. Okay. So that is with respect to the SA 320. I will share this document in the group now. So we are done for today. In the next class, we will start with the SA 420 or 405 we will start with. Okay. Thank you everyone. Enjoy your Sunday.
Thank you, sir.
Thank you, sir.